I think one of the strengths of our team is having, within the income and fixed interest team, we don't run a siloed approach. We have all of the strategies that we manage within the one team. So what that means is that you're getting a better appreciation of the risks that went before you implement a portfolio decision. Within our team, obviously, we've got Tim looking at the govies, we've got Amy giving us input on what's happening in the emerging markets, we've got George giving us input on what's happening in the credit space, and we're obviously backed up by a really well-resourced team. But the benefit of that is you're getting far broader insights into what's happening, and it makes for a better portfolio decision when you start to implement that. That's always a strength of ours, the siloed approach. I just don't think you get that cross-pollination of ideas and a better understanding of the risks before you implement portfolio decisions. So when I look at cash portfolios, I always think of cash as being the Stephen Bradbury of asset classes. It is the best performing asset class when other asset classes have come under stress, and we've seen that certainly, over the last 10 years or so with various things that have popped up, be it COVID or other experiences. But the main thing with our cash portfolios is they need to be highly liquid. Our investors have to know that when they want their money back, that they're able to access their money basically on a same-day basis. So that is a key thing within any cash portfolio, be it for the individual investor, but also as part of our wider income strategy. If we're moving asset allocation around from out of cash into, say, fixed income or credit because those asset classes are becoming more appealing, if your funding source is cash, then they need to be able to access those opportunities. Some of the things I have seen, people going into term deposits to try and increase return. Now, that's a liquidity trade-off. And when I look at cash portfolios, I don't see term deposits with what I'm trying to achieve as being an investment that I'd be necessarily adding a whole lot to. Our investors need to know that when they want their money back, that they're able to access it. And that's how we structure our portfolios. The clients that we do that for, it's wide and varied. So we've got large institutional clients, for example, that want all of their money back on a same-day basis. And we're able to structure those portfolios to meet their liquidity requirements. We do have other investors, insurance clients, or other funds where their cash might be a little bit stickier, and they're able to look at other things that we can add return for them as well. So it may be credit quality, where they're able to take a little bit more credit risk on. It may be the term of the asset, where they're able to extend a little bit further out the curve, and it can also be the security type. So they may go away from your highly liquid negotiable certificate of deposit, for example, out to floating rate notes or other types of instrument. We're able to tailor the cash solutions that we offer to our individual investors' requirements for the larger institutional people that we have. But the key thing, as I've said, it's always liquidity with our cash funds. That is first and foremost what we seek to achieve when we put together a cash portfolio. So when we go to structure clients for our larger institutional clients, we do it either one of two ways. It's either top-down or bottom-up. And when I refer to a top-down solution, it's basically the client coming to us saying, I want a portfolio that gives me a return of, say, cash plus 60 basis points. What we do then is we go away and we have a look at the respective instruments and how that portfolio may look. So we may trade off liquidity, we may trade off credit risk, so we don't go down the credit curve with it. We may look at different security types, so floating rate notes, residential mortgage-backed securities, or whatever else with it. So we can go back to the client and say, this is how we can get you to your target, and these are the parameters that we think may need to happen. That's our top-down approach when it comes to bringing a portfolio solution together. Bottom up, we actually start with the restrictions first. So it may be that the client says, I need a minimum 80% same-day liquidity. So off that, we know that we have to be predominantly in NCDs, overnight deposits. They may give us a target, just with exposure to the major banks, A1, A2 names with it. And off the back of the restrictions that the client actually has from a bottom-up perspective, we're able to bring together portfolio samples on how the return on that sort of portfolio may look. And we sit down and we always work with our clients on, these are tailored solutions. It's your money. We'll manage it to whatever restrictions and criteria that you have. And we have a really collaborative approach with our clients. So we meet up quarterly with them. We're running through, regularly what is happening in the market, whatever else. And that two-way dynamic certainly helps us and it certainly helps them. So it ends up basically in just a better overall outcome for our clients. With cash, the key thing with risk management is always liquidity. So it is first and foremost, can I get my investors back their money? And consequently, I will never compromise a slightly higher return for trading that off against liquidity, whereby I might not be able to get my money back to the client. So it always has to be liquidity first, and then after that, we can work with the client to work on, how they might want a portfolio structured. So I think one of the advantages that we have is just we're in the ideal sweet spot in the Australian market. So we're big enough that we're an important counterparty for all the counterparties that we deal with, but we're also a small enough counterparty that when we add securities that offer us additional margin, our end investors know that that margin that we're getting from those securities will feed through to portfolio outcomes. We're not diluting it across an asset base that is too large. And I think that is one of the key strengths that we have at Pendal here, is our size big enough that we're important, but also small enough that it means that our investors are getting the best result at the end of the day.